Hello and welcome to the Weekly Outlook at XM.com. I'm Maria Pachordes, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be reviewing the week ahead. So Rafi, let's begin with China. We'll get GDP numbers on Monday, and they might offer a glimmer of hope amidst all the gloom. What should we look out for there, and how significant do you think the GDP data is going to be for the markets?
Well, Maria, it is looking increasingly like the case that China is the only major economy that's been able to sustain a steady recovery. We are seeing signs of slowdown in Europe, in the United States, and China, although China was actually the first big nation to record a sharp contraction in GDP because they, of course, had the outbreak much sooner than other countries. They've been able to keep the virus under control, and so the economy has continued to steadily recover, and expectations for the third quarter are for a year-on-year growth of 5.2%, which is quite a remarkable achievement given that only in the first quarter GDP was actually down almost 7% over the year. And in addition to the GDP numbers, we're also going to get the industrial production, retail sales numbers as well for September. And they're expected to show that growth for both industrial output and retail sales quickened in September at the end of the third quarter, suggesting that heading into the final quarter of the year, that growth in China is holding up pretty well. So if that does turn out to be the case, then that should help boost risk sentiment at the start of the week. Of course, in the past week, we've seen quite a deterioration in the market mood given the heightened election uncertainty in the US, as well as Brexit talks not really producing much progress. So the data at the start of the week might help improve risk appetite a little bit, and that should of course be positive for stocks. But as far as the Australian dollar is concerned, which is usually seen as a proxy to China-related trades, we might not necessarily see the reaction in the Australian dollar because we have lately seen a souring of relations between China and Australia, and there are concerns about whether or not whether or not Australia's exports to China are sustainable in the long run if the relations don't improve anytime soon. And of course, we are seeing heightened expectations that the RBA will announce some easing in monetary policy at its next meeting. So the Aussie might not receive much of a boost if the Chinese GDP numbers are upbeat.
Okay, turning to Europe now. Flash PMI reports are due on Friday. The recent PMIs have been disappointing, raising doubts about the recovery. Are we likely to see that trend continue in October? And what kind of a reaction can we expect from the euro?
Well, so the expectations are that we will unfortunately see that downward trend in the PMIs in October. We have seen many countries across Europe announce further restrictions in recent weeks, and that does appear to be having an impact on growth, particularly the services sector, where it's much more dependent than the manufacturing sector on on people being able to go into crowded spaces such as restaurants and shops. So the flash PMIs for October are expected to be particularly positive, and if they are worse than expected, that would raise the prospect of the Eurozone economy heading towards a double dip recession. As far as the euro is concerned, though, it is likely to take a hit from disappointing data, but overall, in the slightly bigger picture, the euro is expected to stay within its recent range of between 1.16 to 1.19 against the US dollar, at least until the US election is out of the way and we start to get clearer signals about how the ECB is likely to respond to this slowdown in the Eurozone recovery.
Over in the UK, we'll get flash PMI numbers on Friday, as well as retail sales data for September. Given that the list of regions under lockdown is growing and hampering the recovery, what reaction might we see in the pound?
So it's a kind of similar picture in the UK. So as you said, we've got a growing number of localities under mini lockdowns. And so the PMIs in the UK are also expected to deteriorate slightly in October. Although overall, the UK PMIs have been somewhat better than the rest of Europe. But if this trend of tighter restrictions continues, then it's only a matter of time where UK PMIs also head towards contractionary territory. The retail sales are also likely to point to slowing growth in consumption. And the pound, of course, we could see a short-term dip in the pound if the data disappoints. But the main focus as far as sterling is concerned are the Brexit negotiations, which are likely to be extended for another 2 weeks. And the further we head towards the end of the year, the more important it's going to be for there to be progress in those talks. So if in the coming days and weeks we do see any negative headlines, then sterling is likely to be much more sensitive to where those talks are likely to be headed.
And finally, in the US, the presidential election on November 3rd is quickly approaching. It seems unlikely that a stimulus bill will be passed before then. In the meantime, can we gain any clues as to the strength of the US recovery from the flash PMIs and housing data?
So we're going to get a flurry of housing numbers next week, and that's one sector of the US economy that has benefited greatly from very low rates, as well as all the various lending programs, various programs the Fed has in order to boost lending. And so it could potentially provide some assurance to markets that the US economy, at least the housing sector, is holding up. That does turn out to be the case from next week's data. We're also going to get flash PMIs as well on Friday. Overall, although the US economy isn't maybe growing as fast as it was earlier in the recovery phase, it's still not doing too badly, and there's less of a chance of a double dip in the US than it is in Europe, at least at this point in time. So as far as the US dollar is concerned, the main priority for traders is the US election, as you said, which is approaching fast at the beginning of November. And we have seen that Trump's campaign gaining some momentum lately, and so as we head closer to that election date, then it's going to be, if markets are going to be keeping a much closer eye on the polls. If they do see that Biden's lead over Trump is narrowing, then that might upset markets, because we have seen investors lately increasingly price in a blue sweep, that the Democrats would take control of both the White House and both chambers in Congress, and which would make it easier to pass a big stimulus package. And if it turns out that the Republicans will probably keep control of the Senate, then that would dent hopes of a big fiscal package being approved anytime soon.
Rafi, thanks so much. And thanks for joining us at XM.com.